Welcome, listeners, to the latest episode. Today, we have a brief overview of the Federal Reserve. Today, in 2 hours and 9 minutes, we are going to know what the Fed is going to do with the rates. So let's dive into that reserve role on and the significance of the FOMC meeting. We also going to look at the stock market updates, what the stock's been doing, of course, interest rates, mortgages, treasuries. We're also going to deep down into the Oregon real estate market. So the first segment is going to be current economic landscape, discuss the current state of inflation and employment, highlight the impact of recent tariffs on economic indicators. Segment number 2 is going to be the Fed's dilemma, basically going to keep the rate or lower the rate. We are going to look into that and what are the statistics for that, analyze the confidence pressure, controlling inflation and supporting economic growth, and examine the political influence and public expectations. In the last segment, we are going to have the potential outcome. We are going to explore the different scenarios, rate cuts, holding steady, or future hikes. And we are going to discuss the implication for investors, homeowners, and the broader economy. All right, so let's jump right in. And of course, first of all, join our channel where you're going to have daily updates about mortgages, about real estate. And let's take a look what the market is doing. So, of course, most of the loans that we are doing, DSCR loans for investors, are based on the US Treasuries. We can see the 5-year Treasury went up a bit. The stock market is expected to go up today. The futures are rising. As for the talks, the expected talks with China, the Trump team is expected to meet the Chinese negotiators in Switzerland later this week, and Trump is also mentioning that he have a huge surprise that doesn't have to be for trade deals. So we are going to see later on what that's going to be. Of course, you are more than welcome to join our forum, 23,000 people. And let's take a look at the USDs. We can see that the USDs overall are going up 2 year, 5 year, 7 year, 10 years. Only the 30 years is going down. 30 years fixed rate, 6.88 for Americans. We just closed a 6.01 for foreign national, a DSCR loan. All right, let's jump back into MBS Live. All right, and we can see the 5-year Treasury going up a bit. All right, and let's take a look about the Fed dilemma, the latest updates from CNBC.
I really wanted to talk to you about what the Fed finds itself in, and it plays off of what you just heard from the president and the Treasury Secretary today, that there are no talks as it relates to the most important counterparty in this trade war, that being China. At the same time, you heard Mike Arrighetti of Ares with Faber this morning that the economy's good. Sure, no one's really hiring that much, and no one's really.
So that's the thing. Economy is good means there's no much reason to lower interest rates, and we are going to look at the statistics.
Doing that much in terms of big, capital deployment because there's this paralysis to some degree. So the Fed is watching all of it and comes away with what?
It's a pickle. It's a dilemma. Find your right word there, Scott. I mean, I guess I would argue a little bit with Michael Arrighetti. Hard to argue that the economy is good if nobody is investing or doing capex, and if they're not hiring. That is not my idea of an ideal economy. I saw a report today from Reuters that M&A is about the worst it's been, had the worst month since 2009. That's also not a good development. So a standstill is not a positive for the economy. It's not a positive for stocks. Right now, the belief among respondents to the CNBC Fed survey is that the Fed is going to look at all this, and it has this issue of higher inflation on the one hand and weaker growth on the other, and it's going to side ultimately with weaker growth. But that comes with a belief, Scott, that the inflation impact from tariffs will be something that hurts this year but goes away next year. It's going to be key for that to happen, for the Fed to believe that, and for it to actually happen, if the Fed can actually cut to address that weakness.
I mean, there is the idea, too, of, as Nick Timmeros was talking about in the Journal today, and I know you've been thinking about as well, the idea of the Fed being in a lose-lose scenario, thinking that they're either going to have to navigate a recession or stagflation. Neither one is going to make Jay Powell and company very sanguine about the situation.
No, and people should not be. I mean, there was a fascinating conversation you guys were having as to whether or not the stock market has embraced the outlook here. And I thought Bryn's comment was really important, the notion of the extent to which small business is taking this on the chin. When Besson, the Treasury Secretary, says this is for Main Street, well, Main Street's about to get hit the hardest of anybody. Think about a large company. Scott, they go in there, they can negotiate for an exemption, they can borrow money, they can reduce a dividend, increase a dividend, do all kinds of stuff. The small folks are just going to let people go. They're going to shut down their businesses. This is a very bad situation. And the reality is that catches up in the statistics later. So I don't see how the Fed has a good choice here. I think it has to take what's coming to it. And I can only follow what Powell said, Fed Chair Powell said, is the way he's going to address it. Look at our mandates, each side of it, figure out which one is furthest from our goal and address that one. That's what it has to do. There are no good choices here, Scott, only the least bad ones.
Yeah, I mean, they say patience is a virtue for a reason, and he probably still has the luxury of patience. And the jobs report maybe gives them a little bit better feeling about that, too. We'll just have to see. The commentary tomorrow down in D.C. when you're there is going to be really, really interesting, along with the questions, including the one I know you're going to ask too. Steve, I got to bounce. I'll catch you later for sure. We'll see you.
All right. Yeah. So definitely small businesses are going to be affected. And today, the 10-year auction is coming to the rescue. 10 years Treasury auction was the only relevant calendar event in terms of potential market movement, and it lived up to its billing. Unlike the set up to many auctions, there was no meaningful weakness in bonds ahead. All right, so we can see that. All right, so as for the economic calendar for today, so Wednesday 7, of course, okay, we are going to have the MBA purchase index. We see the actual 162, prior 146, crude oil inventory, forecast minus 2.5 million, prior 2.6 million. Fed interest rate decision, 2 stars. So forecast 4.5, staying at 4.5, prior 4.5. All right, and we're also going to have the consumer credit. The market are still in grid. We know that when we are going to get to extreme grid, this is the time to sell. We're still in the beginning of the grid period. Just a month ago, we've been in extreme fear. Hopefully, you guys bought a lot. Of course, this is not any recommendation. All right, rates move up after stronger economic data. We can see the recent development. We got the financial stability report and Governor Koch at Michigan State University, James Madison College, spring commencement ceremony, and of course the probability of a rate cut. We can see that as for probabilities, as for today, 95% that we are going to stay same, and also for June, 70% of staying same, 28% of lowering by 0.25, and later on there are higher chances, but many things can change until July. And before we jump into the topics of today, we want to remind you, join the Nadlan Financing Social Network. We get updates every day about every state in the US, about real estate, about financing, about mortgages. You can see all of the updates that we have daily here: case studies, recourse, non-recourse, total debt ratio, and so on. More than that, you're going to get mortgage rates update. This is all on our social network, the Fed's decision. And of course, you can join our courses, daily real estate news and economic news, all of the states that you can join. We got almost 23,000 members. And of course, we also have daily Bitcoin, crypto, and stocks updates, hems and hairs. We're going to go over all of this, different stocks, and hundreds of experts. Whoever doesn't know us, we are doing real estate expos. We're teaching both multifamily, wholesaling, fix and flip. On our website, nadlandeals.com, every day you're getting off-market deals. It's the only website that shows you daily off-market deals. We're also building in Florida and Texas houses for investors below 250K. And of course, we are the largest mortgage broker in the US. We work with more than 3,000 lenders, and we are doing an auction between them to find you the best investment loan. So today we are going to discuss the distance from all-time high of the Magnificent Seven. This is a new update that went up on our post. All right, so let's jump into that. All right, so the S&P status below 200-day moving average, China tariff talks, positive headline driving market response, FOMC concerned, negative reaction could accelerate downside movement. All right, let's see the distance from all-time high. All right, so we have Microsoft at 7.48%, Meta 20.73%, Google 20.84% from all-time high, Apple 23.68%, Amazon 23%. So you just see the potential. Nvidia 25%, and Tesla 43% from all-time high. Current stock prices: Microsoft 433, Meta 587, again 165, 198. All right, so Microsoft needs 8% growth, Meta and Google 26% growth, Apple 31 to 35% growth, and Tesla 77% growth needed to get back to all-time high. Let's see the recent earning reports. SMCI revenue 4.6 billion versus the estimate 5.05 billion estimate. All right, so below expectation. Lucid 235 million compared to the estimated 246 million. Rivian 1.2 billion best expected 1.02 billion. So actually Rivian beats the expectation, and AMD also beats at 7.44 billion compared to 7.13 billion. Earning per share performance, SMCI earning per share 0.31 compared to 0.2, beats it by 55%, Lucid beats by 13%, Rivian beats by 48%, and AMD by only 2%. Let's look at the investment outlook. Monitor the FOMC today, the market reaction. That's exactly 2 hours from now. Track the 200-day moving averages, key technical indicators, China deal progress. All right. We expect that each deal that will be signed can affect the markets in a huge way. But as for now, no deals. Hopefully, the China deal is going to pop up. And again, on our social network that you are welcome to join, the Nadlan social network, the Fed's tough spot, what you should expect today. So let's dive into that.
Okay, so if you're keeping an eye on the real estate market, you've probably noticed things feel, well, a bit uncertain lately.
Like navigating some choppy waters rather than smooth sailing.
Exactly. And right now, the Federal Reserve's FOMC, the Federal Open Market Committee, they're meeting. It's May 2025, and everyone's kind of holding their breath about their next move.
Yeah, absolutely. So this deep dive, we're really going to get into that tightrope walk the Fed is doing right now.
Trying to manage interest rates, get inflation down, but, keep the economy growing too.
Precisely. And what we really want to explore is how this whole situation impacts mortgage rates and, of course, the real estate market you might be interested in.
Right. So to help us unpack all this, we're looking at some insights from Nadlan Capital Group. They discussed this exact FOMC meeting.
Mm-hmm. And also a CNBC video segment from May 6th called The Fed's Dilemma, Higher Prices and Weaker Growth.
Yeah, we already
Pretty
saw the
timely.
video.
Very timely. So our goal today, it's pretty straightforward.
Yeah.
Cut through the jargon, understand the Fed's challenges, and what it means for you, especially if you're thinking about real estate or investing.
Sounds good.
So let's start there. What's the fundamental conflict the Fed's dealing with based on what we're seeing?
Well, the core issue is, like you said, balancing inflation and growth. They want to lower inflation without, triggering a recession.
It's a really fine line.
It is. And their main tool, obviously, is interest rates. Hiking rates cools things down, lowers inflation ideally.
But makes borrowing more expensive, which can slow growth or worse.
Exactly, slow growth. Or, yeah, even tip things into recession. It's a delicate act.
Now, going into this meeting, there was some hope, wasn't there, about maybe some rate cuts?
There was earlier in the year. A lot of investors were pretty optimistic the Fed might start cutting rates fairly soon.
What was driving that? Just signs inflation was maybe easing off.
Yeah, partly. Some early indicators look promising. But as Nadlan Group noted, that hope for near-term cuts is fading fast.
Okay, fading fast. Why? What's pushing back against those rate cut hopes?
Well, there are a couple of big things our sources point to. First off is this idea of sticky inflation.
Sticky inflation, meaning
Meaning, prices just aren't falling as fast as the Fed wants, even with the rate hikes they've already done. Inflation's come down from the peak, sure, but it's proving stubborn.
so too high for their liking.
Right. And that CNBC piece specifically mentioned wage growth, especially in services, as a key reason it's so sticky. It makes it harder to get overall prices down quickly.
Okay, so sticky inflation is one factor. What else is making the Fed hesitant to cut rates?
The other big piece is the job market. It's
Yeah.
just remained surprisingly strong, low unemployment.
Which sounds like good news generally.
It is good news for workers, absolutely. But for the Fed, in this specific context, a really strong job market kind of reduces the pressure, the urgency to cut rates.
Because if lots of people are working and spending, cutting rates could just pour fuel on the fire.
Exactly. It could boost demand even more and risk sending inflation back up again. They definitely don't want that.
Makes sense. And Nadlan Group also mentioned global factors adding complexity. It's not just domestic stuff.
That's a good point. Yeah, things like New tariffs being implemented, maybe rising trade tensions bubbling up again.
How does that play in?
Well, tariffs can disrupt supply chains, potentially make imported goods more expensive. It just adds another layer of uncertainty to the economic picture, makes
Yeah.
forecasting inflation and managing it even tougher for the Fed.
Okay, wow. So sticky inflation, strong jobs, global trade issues,
Mm,
they really are in a tight spot.
they are.
So let's pivot to what this means for, for our listeners.
Yeah.
The big one for many is mortgage rates.
Hmm.
What's the outlook they're likely to be?
Well, given that the expectation is the Fed will likely hold rates steady for now,
Yeah.
it probably means mortgage rates are going to stay around their current, elevated levels for a bit longer.
Ugh, not great news for buyers.
Not ideal. Now, Nadlan Group did mention something interesting, a slight dip in mortgage rates recently.
No. Why was that?
It seemed to be a reaction to a recent 10-year Treasury auction that went pretty well.
Okay, explain that link for us.
Yeah.
Why does a Treasury
Yeah,
auction
we just
affect
spoke
mortgage
about that.
rates? Even a little.
Sure. So mortgage rates are pretty closely tied to the bond market, especially Treasury bonds. Think of Treasuries as like the baseline safe investment.
Right.
When demand for those safe assets is strong, like in a good auction, it can sometimes take a little pressure off other related markets like mortgage backed securities. That can lead to a small dip in mortgage rates.
Interesting. So a ripple effect.
Yeah. But Nadlin was quick to emphasize it was a modest adjustment. The bigger driver for mortgage rates is still going to be the overall economic data, inflation trends,
Uh-huh.
fiscal policy, the big picture stuff.
Got it. So don't read too much into small dips. What about investor sentiment more broadly? How does this Fed uncertainty affect things like the stock market or even housing investment decisions?
Well, uncertainty is almost never the market's friend, right? When investors aren't sure what the Fed's going to do next or if they might make a mistake.
Like cutting too soon or waiting too long?
Exactly. That uncertainty usually leads to more volatility. You see bigger swings in stock prices, and it can make people hesitant in the housing market too, both buyers and sellers.
So maybe more cautiousness all around.
Probably.
Mhm.
Which leads to the advice, really, if you're thinking about big financial moves right now.
That's the takeaway.
Both sources kind of lean towards patience and being strategic. It's probably not the best time for like impulsive decisions based on day to day market noise.
So think carefully, understand your own situation, and watch how the Fed stuff plays out.
Pretty much. Assess your own risk tolerance and needs carefully.
Okay. Looking at this specific FOMC meeting happening now, the base case is they hold rates steady, right?
Yes, that's the strong expectation Nadlin mentioned. No change to the benchmark rate this time.
So what should we be watching for then?
The real action is going to be Jerome Powell's press conference afterwards.
Reading the tea leaves.
Totally.
Less than 2 hours
Everyone will be
away.
parsing his words, uh, looking for clues about the future. The big question is, do they still think rate cuts are possible later this year in 2025?
Or has the timeline shifted?
Or has the outlook changed enough that their hinting cuts might be pushed further out, maybe even into 2026? That's what the market desperately wants to figure out.
So the nuance of the language will be key. Looking at the bigger picture then, what's the overall economic outlook given this balancing act?
It's just difficult. As Nadlin put it, if they cut rates too soon, they risk inflation flaring back up, undoing all their hard work.
Right.
But if they keep rates high for too long, they risk choking off economic growth too much, maybe causing that recession they want to avoid.
So damned if you do, damned if you don't, almost.
It feels a bit like that, which
Mm.
is why the phrase Nadlin used, a wait and see summer, seems pretty apt.
A wait and see summer.
Ah,
I like that.
mm,
So the Fed likely wants more data before making any big moves.
exactly. They'll want to see clearer signs inflation's really heading down sustainably and understand how the economy is holding up under the current rates.
Okay, makes sense. Before we wrap up, any practical tip, something listeners can actively do?
Yeah, definitely. As both our sources really stress, keep a close eye on the incoming economic data.
Like inflation reports, jobs numbers,
Precisely. Inflation reports, employment data, and of course, any official communications from the Fed itself. These are the things that will signal their next steps.
and those steps directly impact markets, mortgage rates, everything we've been talking about.
Absolutely. They're crucial signals.
So wrapping this up, it seems pretty clear the US economy, especially the real estate side, is navigating a period of significant uncertainty. And it really hinges on the Fed's decisions.
Yeah, it's a very delicate moment.
Everything
What
up to
happens
the
at this
Fed.
meeting and the ones
This
that
is why
follow
this
will
meeting is
really
very
ripple
important.
outwards.
Definitely. So here's a final thought for you, the listener, to mull over. How does all this economic uncertainty, this Fed tightrope walk, how might that influence your own financial plans, maybe your decisions about housing or investments just over the next few months?
It's definitely something worth considering carefully as we all watch this unfold.
All right, so what to watch for? 10-year Treasury yield, key indicator for mortgage rates, 2% inflation target. All right, so let's look at the buyer's sentiment. Historic low, worst time ever to buy. All right. Affordability crisis, high rates plus high prices. Waiting game, buyer delaying purchases. International investment, foreign buyers return. Renewed interest in US market. All right. So actually, with all of the tariffs and stuff, we see foreign buyers returning to the US in order to buy. We see rebounds in the stock market and also renewed interest in real estate. Market entry points, strategic location for foreign capital, financing option, special programs for non-residents. Of course, we specialize on that. So what are the expert predictions? So the market analysis, data-driven forecast, growth areas, Zillow's hottest market for 2024 and 2025, and price stability, house prices expected to hold. So, of course, you can have all of our investment resources if you didn't join yet. Our Nadlan University, we're teaching you how to invest. The Nadlan Capital Group, the largest mortgage broker for investors and for foreign nationals, and Nadlan Analyst, basically creating reports for you for every market. And you also can see reports daily in our social network. And as promised, let's jump into the Oregon real estate market. On every episode, we are concentrating on one market. So let's look and see what's going on in Oregon. All right, so we get market overview, an overview of the current state of Oregon's real estate market, slowing price growth. We can see price growth in Oregon real estate is decelerating. Increasing inventory. There is a notable increase in housing inventory available. Interest rates impacting buyer behavior. Rising interest rates are influencing the buyer decisions. DSCR loans, a growing trend. More and more buyers are taking DSCR loans, debt service coverage ratio loans are becoming more popular. This is what we specialize on. Investment opportunities in Oregon, potential investment prospects within the Oregon market, and the conclusion, summarizing the key insight and projection. So let's dive into that. All right, so home prices are rising. Oregon's home prices are continuing to increase, albeit at a slower pace compared to previous years. Inventory levels increasing. The inventories of home for sale in Oregon is gradually rising, offering more options for buyers. DSCR loans gaining popularity, and market deceleration observed. While prices are rising, the overall pace of growth in Oregon real estate markets has slowed down. Investor interest growing. Investors are showing increased interest in alternative financing methods such as DSCR loans. All right, so let's look at the price trends. Home prices have slowed down. Home prices in Oregon are up 3% year over year, indicating a slowdown. Average price is $512,000. Urban areas show stabilization. Urban regions like Portland are seeing price stabilization due to increased inventory. And smaller cities still growing. Cities like Bend and Eugene continue to experience healthy price growth. All right, so we can look at the inventory growth. Increasing supply, the number of homes available for sale in Oregon is gradually rising, offering buyers more options in the market. New constructions Active new construction in cities like Salem, Redmond, and Medford is contributing to the increased housing supply, reduced bidding wars. So the growing inventory is helping to reduce the intensity of bidding wars, providing better opportunities for buyers, and zoning challenges, permitting and zoning challenges in Portland and Bend continue to limit the potential for large-scale development. So what is the impact of interest rates on buyers? Higher mortgage rates, recent increasing in mortgage rates have significantly influenced buyer behavior across the housing market. We see shift towards smaller homes. As affordability declines, many buyers are opting for a smaller home to manage costs more effectively. Focus on suburban markets, buyers are increasingly gravitating towards suburban areas where housing prices are more manageable compared to urban centers. Popularity of adjustable rate loans, more buyers are exploring adjustable rate loans, expecting the rates to go down. And understanding the DSCR loans, basically DSCR loans definition, whoever doesn't know, DSCR loans evaluate a property's rental income to cover debt, appealing to self-employed investors, for example, foreign nationals. No personal income verification. You don't need to bring any W-2s. No tax return, easing access to financing. Flexible terms, loan amount can go up to $5 million with options like interest-only payments. Broad eligibility applicable to diverse property types, single-family homes, condos, multi-units. All right, so DSCR loans surge in Oregon. Growing popularity of DSCR loans. DSCR loans are gaining traction among investors in Oregon, indicating a shift in financing preferences. Major lenders offer such options, alternative financing solutions, and emerging markets. Cities like Eugene and Grants Pass are attracting investors due to affordability and strong rental demand. Strong rental demand, the investors can acquire properties with favorable cash flow potential. We can see that urban centers, Portland's urban market offers opportunities in revitalized neighborhoods, price stabilization. While Portland has stabilized, there are still investment chances in high demand areas. Revitalization areas, investors should focus on neighborhoods undergoing growth. All right, so let's see the summary. Balanced market transition. Oregon real estate market is moving towards a more balanced state, indicating a shift from seller's market to a more equitable environment for buyers. Slowing price growth, increasing inventory levels, opportunities for investors with DSCR loans, urban versus suburban markets. Both urban and suburban markets are showing signs of growth. Emerging investment strategies. Investors should consider emerging investment strategies to leverage current market conditions. All right, so we spoke about what is DSCR, the importance of it in real estate. The DSCR requirement in Oregon, different lenders may have varying DSCR requirement, but typically a DSCR of 1.2. So we work, again, with more than 3,000 lenders. And, of course, the benefits. All right, so our last coverage for today. Let's look at the home price trends analysis. All right, so we can see an overall in the US home price appreciation. Both major home prices indices agree on an average annual appreciation between 4 to 5%. February index changes, FHFA index increased by only 0.1%, while Case-Shiller rose by 0.7%. Annual trends, Case-Shiller shows 4.5% annual growth. FHFA decreased from 5% to 3.9%. monthly movements, the gap between highs and lows has increased compared to 2014 to 2019. Seasonal adjustments, indices are not seasonally adjusted, showing typical seasonal price patterns. The current market position, FHFA index near lowest level in 12 months. All right, so what is the market observation in housing? We can see market uncertainty. The recent fluctuation in home prices raised questions about potential shifts or concerns in the housing market. September price peak. An abnormal peak in FHFA prices was recorded in September last year, indicating possible price trend anomalies and factors influencing prices. Home prices are influenced by various factors: the labor market, the interest rate, the inventory, and affordability aspects. So, what are the current average mortgage rates? All right, for 30 years fixed, 6.9%, 15 years, 6.119, 30 years FHA, 6.28, 30 years jumbo, 7%, and 5/1 arm, 6.45. And what are the recent housing market data? Mortgage application in April 30 was 223. It moved down 4.2%. Building permits 1.4 million, went up 1.58%. Housing starts 1.3 million in March 1st, went down 11.38%. New home sales 724,000, went up 7.42%. Pending home sales 76.5, went up 6.25%. Existing home sales 4 million, went down 5.63%, and builder confidence 40 went up 2.56%. So what are the recent trends in mortgage rates? Rates move up after stronger data. As of May 2nd, mortgage rates increased following the release of stronger economic data, indicating a potential shift in the market dynamics. The markets calmed down immensely as of April 25th. Markets experienced significant stabilization, with rates reaching their lowest points since April 7, suggesting a momentary easing in volatility. Mortgage rates lowered this week. Mortgage rates were reported to be lower, providing a potential relief for home buyers in an otherwise fluctuating market. And the biggest weekly jump in rates was in April 11, so the largest increase in rates. All right, so of course you can contact us for other insights. All right, guys, so thank you for joining us today for this market update. We are doing this daily, showing you what are the interest rates and of course what the markets are doing, deep diving into different real estate markets in the US. You can get daily updates on the Nadlan social network. We constantly update all of the 50 states with statistics, with data, also stocks, financing, mortgages, AI. All of this you can find on our network. You can download our app, the Nadlan Social Network, both on Android and Apple, or go to forumnadlanusa.com and join. So thank you everyone for joining us for another market update, and we will see you tomorrow.